Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for November 5th, 2017. Market breadth with this past week's market fractional advance. Our bull-bear point and figure ratio at 1.52 declined slightly from 1.59 last week, yet remained within bullish territory. The total count of securities in bullish or bearish patterns decreased fractionally to 3,201. The count of bearish stocks increased 3%, while the count of stocks in bullish patterns decreased 2%. The Pirls P&F Market Breadth Summary Chart shows us a market now 10 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To subscribe to our weekly Pirls Stock Market Commentary via email free of charge, simply enter your name and your email address in the spaces required and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 143 points for the 11th decline in 28 weeks. At a positive 304.12 points, it has fallen below the May 2016 and February 2017 tops, continues below the April 2016, the October 2017, and the July 2016 tops, and continues above the July 2017 top, and continues above all 5 bottoms in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 3 accumulation days and 4 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in accumulation mode on higher average daily volume. Momentum. The CCI 20 daily in a Woody's uptrend is now at a positive 159.19, down from a positive 207.27 last week. At Thursday 10/26 close, the CCI 20 daily was within the plus or minus 50 range for a zero-line reject long entry signal at Friday 10/27 close. The CCI 20 remains above plus 100, so we stay in the trade. We will continue to follow this trade simulation in next week's commentary. In Woody's CCI trading system, 6 consecutive bars above or below 0 are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 79 weeks ago, while the daily CCI 20 began a Woody's uptrend 8 weeks ago. The CCI 20 weekly, at a positive 175.51, rose from a positive 155.79 last week after forming a zero-line reject long entry signal for Tuesday 9/5 open. Our rule is to stay in the trade until the CCI 20 drops below plus 100. We will continue to follow the result of this trade simulation in next week's commentary. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: some tech, S&P retail, oil services on top, gold and silver, and some tech on the bottom. Bullish, semis, comp tech, and S&P retail continue in the top 5. Gold and silver continues in the bottom 5. Brokers has left the bottom 5. Bearish computer hardware continues in the bottom 5. KBW Bank has left the top 5. Oil services has left the bottom 5. Focus this week from www.altmarket.com. The Economic Endgame Continues by Brandon Smith. Some key points are the following. As I have shown in great detail in the past, the globalist agenda includes a fiscal endgame, a prize or trophy that they hope to obtain. This prize is a completely centralized global economic structure, rooted in a single central bank for the world, the removal of the U.S. dollar as world reserve currency, the institution of the SDR basket system, which will act as a bridge for single global currency supplanting all others, and ultimately global governance of this system by a mere handful of elites. As noted in the globalist-owned magazine The Economist, in an article titled "Get Ready for the Phoenix," the year of 2018 seems to be the launching point for the Great Reset. This timeline is supported by the numerous measures already taken to undermine the dollar dominance in international trade, as well as elevate the International Monetary Fund's SDR basket. The end game continues faster than ever before, and here are some of the indicators showing that the predictions of the globalists at The Economist in 1988 were more like self-fulfilling prophecies, and 2018 remains a primary nexus point for a re-engineering of our economic environment. I often see the argument presented that the loss of the petrodollar can only be a good thing for the world. I am not here to comment on whether the end of oil denominated in dollars is a good or bad thing. I am here, though, to point out that there is absolutely no indication whatsoever that major Eastern powers like Russia and China are acting to undermine the existing globalist system. Eastern political and economic officials have consistently called for a new reserve system supplanting the dollar. This is true. But what so many analysts seem to overlook is that they also call for that new system to be dominated by the IMF. The delusion that the financial world operates on is that the IMF is controlled by the U.S. It is not. It is controlled by international bankers who have no loyalties to any specific country. As George Soros proclaimed back in 2009, the New World Order would rely in part on China as a replacement economic engine for the globalist machine and depend far less on a diminishing United States. China would serve as a smaller engine, but a replacement engine nonetheless. There will be no single reserve currency after the dollar is brutalized, at least not until all currencies are homogenized through the SDR basket and finally replaced with a single global currency unit. Until then, the IMF or the BIS will dictate nation-to-nation trade and monetary exchange. There are many ways to destroy the dollar, but the best method would be to end its petrostatus. Even in 2014, I was not fully convinced we had enough evidence on what that unit of measurement would be or look like. Today, it is clear as crystal. The one world currency system will not only be a cashless system, but it will also be based on digital blockchain technology. With central banking mascots like Ben Bernanke becoming keynote speakers at blockchain conferences, it is not exactly an elusive secret that the global banks love blockchain tech. What is interesting to me is that even in the highly vigilant world of alternative economics, which is well aware of the trend toward a global currency system, blockchain systems are still revered as if they will save us from central bank tyranny. An observant person, however, might have noticed that central banks around the world seem to be acting in a coordinated fashion to remove stimulus support from markets and raise interest rates, cutting off supply lines of easy money that have long been a crutch for our crippled economy. For the real puppeteers at the Fed, one would need to look to an organization outside the U.S. called the Bank for International Settlements. Changes we think were abrupt during historic moments of crisis were often not abrupt at all. Almost all financial crisis events were preceded by years, if not decades, of growing but subtle cracks in the foundation. The skeleton of the New World Order economy is right in front of us. The triggers for explosive change have already been planted. What concerns me is, when these changes come to fruition and crisis follows, will the masses even notice? Thank you for watching this week's Sand to Pearls Stock Market Commentary video featuring the proprietary bull-bear point and figure market breadth summary chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.